Most people never think about the safety of their brokerage account until something dramatic happens in the financial world. One day, everything feels normal. Markets are moving, dividends are coming in, investments are quietly compounding in the background. Then suddenly, a headline appears. A major financial institution collapses. And instantly, a question appears in the back of every investor's mind. Is my money actually safe? If someone asked you right now whether your money is safe inside platforms like Fidelity, Vanguard, or Charles Schwab, your answer would probably sound confident at first. Something like, of course it's safe. These are huge companies, millions of investors trust them, they've been around for decades. And to be fair, that instinct is mostly correct. But when it comes to your retirement savings, mostly correct is not the same as completely correct. Understanding the difference matters more than most people realize. Because the real answer isn't based on trust. It's based on structure. In this video, we're going to walk through exactly how brokerage accounts actually work behind the scenes. We'll look at what the law says about your investments, how assets are separated from the brokerage itself, and what actually happens the moment a major brokerage firm fails. Not the theory, the real sequence of events. What happens the day the news breaks, what happens the next morning when you open your app, and what ultimately happens to the investments inside your account. But before we go any further, we need to address the moment that made millions of investors start asking this question again. Because the fear didn't appear randomly. It came from something very real. In 2023, 4 major US banks collapsed in rapid succession. Silicon Valley Bank, Signature Bank, First Republic Bank, Silvergate Bank. These weren't tiny institutions operating quietly in the background. Silicon Valley Bank alone held around $175 billion in deposits before it failed. For years, it was considered stable. Reliable, respected, and then almost overnight, it disappeared. Customers woke up to the news that the institution holding their money had collapsed, and that moment triggered a wave of anxiety across the entire financial system. Not just among bank customers, among investors too. Millions of people opened their brokerage apps and had the exact same thought. If something that large can fail, what stops the same thing from happening here? That reaction is completely understandable, but it's also based on a comparison that isn't actually correct. Because banks and brokerages operate under completely different rules. To understand why brokerage accounts are structured differently, we first need to understand something most people have never fully thought about. What actually happens to your money when you deposit it into a bank? Because the moment that deposit happens, something subtle but extremely important changes. When you place money into a bank account, whether it's checking or savings, the money technically stops being yours. Legally speaking, that money becomes the bank's property. In exchange, the bank gives you a promise that says they will return the same amount of money to you whenever you request it. From that moment forward, you are no longer someone who owns that specific money. You are someone the bank owes money to. And that distinction is the foundation of the entire banking system. Because once the bank holds your deposit, it doesn't just leave that money sitting there. It puts that money to work. Banks lend it out. They issue mortgages, they finance car loans, they purchase bonds, they provide business loans. Those activities generate interest. And that interest is how banks make money. Think of it like giving cash to a friend and asking them to hold it for you. But instead of storing it safely in a drawer, your friend immediately goes out and invests it. If that investment succeeds, your friend can easily return your money when you ask for it. But if the investment loses value, the money that was supposed to be waiting for you might not actually be there anymore. And that is exactly what happened during the Silicon Valley Bank collapse. The bank had invested enormous amounts of deposited money into long-term government bonds. Normally, those bonds are considered extremely safe. But when interest rates rose sharply in 2022, the value of those bonds fell dramatically. Suddenly, the assets the bank held were worth far less than expected. When depositors rushed to withdraw their funds, the bank simply didn't have enough liquid money available to meet those withdrawals. In less than 48 hours, a 40-year-old institution collapsed. And that event made millions of investors ask a completely reasonable question. If banks can fail like that, what about the places holding our investments? To answer that question, we need to look at how brokerage accounts are built. Because unlike banks, Brokerages operate under a completely different structure, and that structure changes everything. To understand why brokerage accounts are structured differently from banks, we need to look at something most investors have never examined closely, where your money actually sits after you invest it. Because the moment money enters a brokerage account, it does not become the brokerage company's money. In fact, the law specifically prevents that from happening. Let's take a real example. Charles Schwab manages roughly $12 trillion in client assets. That number sounds enormous, and it is. But here's the detail that changes everything. Schwab's own corporate balance sheet is only a fraction of that size. A company's balance sheet is simply a record of everything it owns and everything it owes. Buildings, technology, cash reserves, debt, liabilities, all of it shows up there. But the trillions of dollars belonging to Schwab's customers do not appear on that balance sheet. Not because of accounting tricks, because they legally cannot. Brokerages are prohibited from treating customer investments as company property. That rule exists to prevent exactly the kind of situation we saw with bank collapses. When you invest through a brokerage, your assets enter a completely separate legal category. The brokerage is allowed to hold and manage your account, but it cannot treat your investments as its own capital. It cannot borrow against them. It cannot sell them to pay its own debts. It cannot move them onto its balance sheet. In other words, your brokerage acts more like a custodian and administrator, not an owner. A simple way to imagine this is to think about a storage facility. You rent a storage unit. Inside that unit, you place everything valuable you own. Furniture, documents, equipment, whatever you want to store. The company running the storage facility manages the building. They maintain security. They keep the lights on. But they cannot open your unit and sell your belongings if they run into financial trouble. Your property remains yours. Your investments inside the brokerage account work in almost exactly the same way. The brokerage manages the system around the account, but the assets inside the account remain legally separated. And that separation is the reason brokerage failures behave very differently from bank failures. If a brokerage company were to collapse tomorrow, creditors could only pursue the assets belonging to the brokerage itself. Office buildings, technology infrastructure, corporate cash. But the investments belonging to customers would remain outside that pool entirely. They were never the brokerage's property in the first place. That legal separation forms the first layer of protection for investors. But there's another question that usually comes up immediately after hearing this explanation. And it's a very good question. What about the investments themselves? Many ETFs and mutual funds carry the name of the brokerage firm. For example, SCHD is associated with Schwab, VTI is associated with Vanguard, FXAX is associated with Fidelity. So if a brokerage collapses, wouldn't the funds tied to that brokerage collapse as well? The answer is no. And the reason why reveals another layer of protection most investors never notice. Because the brokerage doesn't actually hold the assets inside those funds. Every ETF and mutual fund is required by law to hire an independent custodian. This custodian is a completely separate financial institution whose only job is to safeguard the underlying assets, the stocks, the bonds, the cash reserves, everything inside the fund. Large custodians like State Street Bank and BNY Mellon perform this role for many of the largest funds in the world. That means when you invest in a fund like SCHD or VTI, the brokerage company whose name appears on the fund is not physically holding those assets. The custodian's job is simple but extremely important. They maintain possession of the underlying investments. They verify ownership records, and they ensure the assets remain separated from the brokerage firm itself. This separation exists because of lessons learned from financial fraud in the past. One of the most famous examples is the Bernie Madoff scandal. Madoff operated both as the investment manager and the custodian of client funds. In other words, he controlled the investment decisions and held the assets. There was no independent third party verifying the money actually existed. That lack of separation allowed the fraud to continue for years. Modern investment regulations were designed specifically to prevent that kind of situation from happening again. Today, legitimate funds must maintain strict separation between the manager of the investment and the custodian holding the assets. So even if a brokerage firm disappears, the assets held by the custodian remain fully accounted for. They don't vanish. They don't become part of the brokerage's bankruptcy. They remain tied directly to the investors who own them. But understanding the structure still leaves one important question unanswered. What does this actually look like in the real world? Not the legal theory, the actual moment when something goes wrong. What happens on the day the news breaks? What happens when investors open their accounts and see the headline announcing that a brokerage firm has failed? To answer that, we need to walk through the sequence of events step by step, because the way the system responds may be very different from what most people expect. Now let's imagine the situation actually happens. It's early Monday morning. You wake up, check your phone, and see the headline everywhere. Major brokerage firm files for bankruptcy. Maybe it's Fidelity, maybe it's Schwab, maybe it's Vanguard. Whatever the name is, the reaction for most investors will be immediate. Confusion, concern, maybe even panic. Your first instinct would probably be to open your investment app and check your account. And the first question running through your mind would be simple. Is my account still there? The answer, in almost every real-world scenario, is yes. Your account will still exist. Your positions will still be listed. Your shares would still appear exactly where they were before the news broke. But the important work to protect those accounts would already be happening behind the scenes. Because the moment a brokerage collapses, a specific organization steps in automatically. That organization is called the Securities Investor Protection Corporation, or SIPC. SIPC was created in 1970 specifically to deal with brokerage failures. Think of it like the emergency response system for the investment industry. They don't prevent firms from failing, but when a failure happens, they immediately begin the process of protecting investors. The first thing SIPC does is appoint a trustee. The trustee is essentially the person placed in charge of the entire recovery process. Their responsibility is not to save the brokerage company. Their responsibility is to protect the clients. And the first task of that trustee is simple. Check inventory. Every account, every investment position, every share, every dollar of cash. But remember something we discussed earlier, though, your investments were never sitting inside the brokerage company itself. They were held by custodians, companies like State Street or BNY Mellon, which means the trustee is not scrambling to locate missing assets. The assets are already accounted for, already separated, already recorded. This dramatically simplifies the process. Instead of trying to rebuild records from scratch, the trustee simply verifies what the custodian already knows, which investor owns which assets. Once that verification process begins, the next step happens quickly. Client accounts are transferred. Within days, sometimes even faster, accounts are moved to another functioning brokerage firm. Your investments don't disappear. They don't need to be liquidated. They simply move to a new platform. You might log into your account one morning and notice something unusual. The logo at the top of the screen is different. Your brokerage account now exists at a different firm. But when you look closer, everything else is exactly the same. The same ETFs, the same number of shares, the same cost basis. Even the purchase history moves with the account. From the investor's perspective, the transition can feel surprisingly uneventful. And that outcome is not accidental. The entire regulatory system around brokerages was designed to make that process as smooth as possible. This is where SIPC insurance also plays a role. SIPC protection covers up to $500,000 per customer. This includes a maximum of $250,000 for uninvested cash sitting in the account. But here's something important to understand. SIPC insurance is often misunderstood. It is not the primary protection for your investments. It is more like a safety net in case something goes wrong during the transfer process. For example, if a brokerage failed and certain securities were missing due to operational errors or fraud, SIPC could step in to help replace those assets up to the coverage limits. But in most real brokerage failures, the securities themselves are not missing, because the custodian structure already protects them, which means SIPC ends up acting more like a cleanup crew rather than the main shield. The real protection was already built into the system long before the failure occurred. Your investments were never owned by the brokerage. They were simply administered by it. And that difference changes everything when a company collapses. However, even after hearing all of this, there is still one concern that many investors quietly hold in the back of their minds, a concern that doesn't involve legal structures or custodians or insurance limits. Because there is one thing no system can completely shield you from, and understanding that final risk is actually the most important part of this entire conversation. up to this point, everything we've talked about should feel reassuring. Brokerages don't own your investments. Custodians hold the assets separately. SIPC exists to organize the recovery process. And when a brokerage collapses, your account simply transfers to another firm. Structurally, the system is designed to protect investors. But there is an important nuance here that many people overlook. Because while brokerages cannot take your investments, they also cannot protect those investments from the one force that controls every financial market, the market itself. And this is where the conversation shifts from brokerage risk to investment risk. Those two things sound similar, but they're completely different. Brokerage risk is the risk that the company managing your account fails. Investment risk is the risk that the assets inside your account lose value. The system protects you from the first one. It cannot eliminate the second. Let's think about what kind of situation would actually cause a giant brokerage firm to collapse. Companies like Fidelity, Vanguard, and Schwab manage trillions of dollars. They operate globally. They serve tens of millions of investors. For one of those firms to fail, something extremely serious would likely already be happening in the financial world. We're not talking about a minor market correction. We're talking about something much larger. A severe financial crisis, a collapse in global liquidity, or a massive disruption in the economic system. In that type of environment, the value of many investments would already be under pressure. Stocks might be falling. Bond markets could be volatile. Entire sectors could be losing value rapidly. And that brings us to the most important point in this entire discussion. Even if your brokerage account is perfectly protected, the price of your investments can still change dramatically. Your shares of an ETF still exist. Your positions are still yours, but the value of those shares is determined by the market, and markets respond to economic conditions. Think back to moments like the 2008 financial crisis or the market panic during the early days of the pandemic. Brokerage firms didn't collapse, but markets moved violently. Stocks dropped quickly. Volatility surged. Entire portfolios temporarily lost large portions of their value. And yet, the investors who stayed, invested, and allowed markets to recover eventually saw those declines reverse. That's the fundamental trade-off of investing. When you invest in businesses, you accept market fluctuations in exchange for long-term growth. Brokerages simply provide the infrastructure that allows those investments to exist. They are the platform, not the engine. Understanding that distinction is incredibly important because it helps investors focus on the risks that actually matter. If you're worried about your brokerage failing, the structure of the financial system already provides strong protections. But if you're worried about your investments losing value during market downturns, that is something every investor must learn to navigate personally. Diversification, long-term thinking, and emotional discipline become far more important than the platform you use. In other words, choosing between Fidelity, Vanguard, or Schwab really determines the success of your investment strategy. The success of that strategy depends on the assets you hold and how long you're willing to hold them. So while brokerage collapses make dramatic headlines, they are really the event that determines whether investors build wealth over time. The market itself plays that role, and the market operates under a completely different set of forces. But before we finish, let's step back and bring everything together. Because the answer to the original question becomes much clearer once you see the entire structure at once. So after everything we've walked through, let's come back to the original question. Is your money actually safe inside a brokerage like Fidelity, Vanguard, or Schwab? The honest answer is yes. Structurally, legally, and operationally, your investments are designed to remain protected even if the brokerage company itself fails. Your assets are legally separated from the firm's balance sheet. They are held by independent custodians. They are recorded in your name. And if a brokerage collapses, organizations like SIPC step in to coordinate the transfer of those accounts to another broker. In most scenarios, investors don't lose their shares. Their accounts simply move. Different platform, same investments, same ownership. The protections behind that system have existed for decades. Many parts of the structure were strengthened after past financial crises, and each time the system has been tested, it has worked as intended. But there's a deeper lesson behind all of this that often gets missed. When investors ask whether their money is safe inside a brokerage, what they are really asking is something slightly different. They are asking whether their wealth is protected from uncertainty. And that's where the final piece of the puzzle comes in. because no brokerage, no regulator, and no insurance program can remove the fundamental uncertainty that exists in financial markets. Markets rise, markets fall, economies expand, economies contract, and the value of investments moves with those cycles. That movement is not a flaw in the system. It is the cost of participating in long-term wealth creation. When you buy shares of companies, you are buying ownership in businesses that operate inside a changing economy. Some years will feel calm, other years will feel chaotic. But over long periods of time, productive businesses have historically grown alongside the economy itself. And that is why investing works. Not because it removes risk, but because it rewards patience. So the real takeaway from this conversation isn't just that brokerages are structurally safe. The real takeaway is understanding where the actual risks live. Brokerage risk is largely controlled by regulation and legal separation. Market risk is the natural part of investing that every investor must accept. Once you understand that difference clearly, the entire system becomes much easier to navigate. You stop worrying about the platform holding your investments, and you start focusing on the things that truly matter. Choosing strong investments, staying diversified, and allowing time to do its work. Because in the end, the brokerage account is just the container. The real story is what you put inside it, and how long you allow those investments to grow. If you want to see what a $5,000 investment can realistically turn into over time, click the video on the screen now. I'll walk you through the exact ETFs, how to allocate the money, and how that single investment could potentially grow into a portfolio worth over $500,000.